Thanks very much for joining us. My name is Chris Greenfield. I'm with the Federal Metal Company, a brass and bronze ingot maker based in Cleveland, Ohio. It's my pleasure today to present the spotlight on copper. We have an absolutely brilliant panel, and I'm not going to bore you with lots of preamble leading up to it. We have three speakers, all of whom I'm very familiar with, who will offer, I think, unique and valuable insights into the metal that we all trade actively every single day. Before we get started, I would like to point out the antitrust sheets that are sitting in the chairs next to you. It's inappropriate for anyone in this room other than our analyst, Pat Moore, to talk about forward pricing. It's her opinion that's allowed to be discussed. For the rest of us, that's a violation. If you have any questions about those antitrust forms, go ahead and read them. We also have an attorney from ISRI in the audience to make sure we don't step out of line. We're going to go ahead and get right started. Our first speaker today is Pat Moore with Scotiabank. I've heard Pat speak on at least 2 other occasions, and I've always found her to be uniquely insightful into the markets of copper, et cetera. She handles all metals and energy analytics for Scotiabank. She's based in Toronto, an alum of the University of British Columbia right here in beautiful Vancouver, and she was born and raised here in Vancouver. So without further ado, I'd like to introduce Pat Moore.
Well, good afternoon, ladies and gentlemen. On behalf of Scotiabank, it's a great pleasure to participate in the ISRI Copper Spotlight panel. What I'd like to do this afternoon is talk to you mostly about the outlook for some of the economic indicators that impact on copper, then give you our specific forecast for copper prices, and add a comment on zinc, which actually is my favorite of the base metals for the market and for investors. So I'd like to start by showing you our Scotiabank Commodity Price Index. This is an index that my team and I put together some time ago to better reflect commodity price developments of particular importance to the Canadian resource industries. And of course, Canada is a very resource-oriented economy. This was the first index ever designed for Canada. It trade weights the relative importance of different commodities in Canada's net exports. And when we re-weighted the index back in early 2012, we discovered that energy, oil, and the full suite of energy products, including natural gas, accounts for almost 40% of Canada's net exports of all commodities. Metals and minerals, though, retain a very strong part of the overall component, with 30% weighting. Forest products about 15 to 16%, and key agricultural products also 15 to 16%. The thing I did want to draw your attention to, if you actually look at the red line, is how low commodity prices currently are. Now, most commodities are traded in US dollars, and of course, the US dollar has been quite strong against many currencies around the world, particularly in the past year. And it's having a bit of a deflationary impact on commodity prices. But the other thing that has happened, of course, is that we've now had 3 years running of very lackluster global economic activity, and I'm going to show you what that has meant a little bit further in the presentation, and it's leading to extremely competitive markets for many commodities. And of course, we've got an effective fight for market share ongoing in oil and also in the iron ore industries. And it's had recently quite a downward impact on the overall commodity market space. We're just now coming out of an effective recession in the Eurozone, but that is very weak economic conditions in the Eurozone have also been a negative for the commodity market space. So all in all, as of March of this year, our Scotiabank Commodity Price Index actually has fallen to the lowest level since January 2007. In other words, it's actually below the low back in December 2008 during the previous Great Recession. And I'm hoping that commodities generally are going to bottom in the next few months. We see a slow recovery in oil prices, though a very up and down recovery, a lot of volatility. I think the bull run in metal prices is going to return probably around the 2017 period. Once current huge mine expansion in copper is over. Copper is still considered to be the bellwether within the base metal space. And I think that in the next few years, the markets are gradually going to recognize tightening supplies for zinc and nickel. And I think later in the decade, once the iron ore producers, the major producers in Western Australia and Brazil, have put in place their expansion in iron ore, I think we're going to have a return to much stronger metal markets, again, around the 2017 timeframe. So if you had to choose one particular economic indicator particularly for the base metals, but also for ferrous metals, you would pick the Purchasing Manager Index for manufacturing in China. And it is shown in the red line on the chart. And what you can see is that recently the PMI for manufacturing in China has been just flirting with the 50 mark. Anything above 50 indicates that manufacturing orders are rising. If it's below 50, manufacturing orders are probably contracting. We had back in February moved below the 50 mark. In March, it's moved back up again to the 50 plus mark. But generally, we're starting this year on a soft note in China. Industrial activity in January, February advanced by a mere 6.8% year over year and slowed to only 5.6% year over year in March. That's the slowest industrial production number for China. You have to go back to 2008 to see anything that slow. So we are starting the year off very slowly in China. It's had an impact, of course, on the base metals. The prospects, though, in the U.S. economy appear to be brightening, although it's a bit up and down. We're expecting very strong consumer spending in the U.S. economy. A dollar drop a gallon in the price of retail gasoline is going to do a lot for consumer balance sheets and going to lead probably to very strong demand for gasoline this spring and summer in the driving season. We're also expecting a pickup in residential construction, which has been underbuilt now for at least 5 years. So all in all, expecting better growth in the U.S. Through 2015. The one thing I did want to mention on behalf of the Eurozone, and quite a different development, is that after declining auto sales last year, auto sales are picking up in Western Europe. And in fact, we're going to have quite a good growth number this year. And of course, the last 2 years, we've had record auto sales and production around the world. It's very metal intensive. And we're expecting another new record high this year and next in the global auto sector. I should mention that beginning this year, the expectations for global economic activity have not been particularly bright. And that marks quite a difference in the way things have moved in recent years, because usually you start every year with a lot of optimism about improvement for global economic activity, and then in the third quarter the numbers are all revised down. And if you've ever wondered why the equity markets usually correct around September, it's because of those downward revisions to world economic activity and general expectations in the financial markets. But this year things are starting out with quite negative, soft sentiment, and we hope that we'll finish on a stronger note. So I'd like to show you this chart, and in every presentation I do on global commodity prices, I do show this chart because it actually tells the whole story of global commodity price developments in recent years. It simply plots China's industrial production in the red, year-over-year percent changes, against the G7 in the blue. And you can see in 2008 the very sharp downturn in G7 industrial activity. China also experienced a slowdown in industrial production, but their industrial production year over year never went negative. And the bottom was actually in January, February 2009 at 3.8% that I'm showing at the top of the table. And then through a massive infrastructure spending program, record credit expansion, they were able to lift their economy out of the global recession. And it's one of the key reasons why the performance of commodity prices, and I'll go back to the first chart, you can see that coming out of the 2008 recession, we had an unusually rapid improvement in global commodity prices. And I say unusual because in previous business cycles, you would never have commodity prices rallying, which they did in January 2009 when the US economy was still in a very steep recession. But back in early January 2009, when the LME traders and the COMEX traders saw China's State Reserve Bureau buying things like base metals, aluminum, copper, zinc, at bargain basement prices, they realized that China was back, and they jumped back into their positions, driving prices higher when the US was still in a recession. But you can see April 2011 marked the advent of difficulties with excessive sovereign debt in the Eurozone, with financial markets and commodity players realizing that dealing with that excessive sovereign debt would mean austerity measures that would slow global economic activity and therefore slow demand growth for commodities. And you can see that things started to wobble later in 2011, 2012. So before leaving this slide on China versus the G7, I just wanted to point out to you the recent slowdown in industrial activity in China, but a modest pickup in the G7 industrial world, with the US performing better, Germany sometimes performing better, and we've noticed recently quite a pickup in consumer spending and auto sales in Germany. Japan still having some difficulty lifting their industrial activity. The small table at the bottom is very important for people in the base metal industry. It shows China's share of global consumption, the estimate for this year, compared with the US. And what you can see in copper is that China's share is now almost 46% of world consumption for copper, the US about 8%. And for the four key base metals, China's almost 49% of world demand, the US about 9%. So China is a 4 times bigger market than the United States now. Now, I'm a Canadian and an economist, so I now spend a great deal of my time looking at the outlook for China, despite the fact that economic activity in China is slowing. As I mentioned, we're now into the 4th consecutive year of global economic activity just over the 3% mark. Now, 3% doesn't sound like a bad number, and it is sufficient to tick over the global economy, but it is not strong enough to have really robust commodity prices. Back in the 2000 to 07 period, when we had a tremendous run-up in global commodities, the economic growth rate around the world was about 4.5%. So things have slowed quite markedly. We do think at Scotia Economics that economic activity is going to accelerate to about 3.7% in 2016. We have the U.S. generally performing better, and India moving back up into the 7% mark. And you notice that India's GDP growth now at 7.5% this year is higher than China's at 7%. And that's causing a bit of excitement in some markets, with people wondering if India is going to pick up the baton and move the global economy higher. Japan, very slow economic activity, and the Eurozone gradually lifting out of its recession of about 3 years running. Russia, unfortunately, is in a recession as we speak this year, partly due to the Western sanctions, and we expect a slight improvement in 2016. So I wanted to say a few words about China. I've actually been a bull on the Chinese economy now since the middle of the last decade, but I realize that China's potential is gradually slowing. Of course, they have less underutilized labor. They've overbuilt many manufacturing industries, and recently, the leadership in China, Mr. Li Keqiang, is now putting a lot more emphasis on expanding the service industries, which are quite undeveloped in China, things like banking, insurance, healthcare, environmental industries, and they're really almost de-emphasizing the heavy industry, and partly because of real issues now with air pollution, not only in the big Tier 1 cities like Beijing and Shanghai, but even in places like Xi'an, which this is the location of the Terracotta Warriors, a wonderful place, but the air quality is not good there, and a lot more emphasis, I think, in coming years on environmental controls, closing down high-polluting plant, and that will take a bit of a toll, I imagine, on industrial activity. Now, China, with the new leadership that came into place in early 2012, they have a reform agenda which they're working through, and they want to do things like have a more decisive role for markets rather than a centrally planned economy. They want fiscal reform to deleverage municipal finances, better aligning spending obligations with revenue by shifting some spending from the municipalities who financed a lot of that huge infrastructure back in early 2009, shifting those spending obligations to the central government, the beginning of rural land reform and state-owned enterprise reform, and a lot of financial sector reform that we're beginning to see now at the bank, at our office in Shanghai. So we think that if effectively implemented, these reforms are going to enable China's economy to achieve reasonable economic growth over the balance of the decade, but the growth is slowing, and we think for next year, 2016, probably GDP growth of about 6.5%. Now, this is really important, partly because the idea that China's GDP is going to slow into the sixes causes real financial market ripples and concern in New York and in London. And one of the key reasons why the base metals have been a little softer in the past year. However, I remain a bull, particularly for the base metals, medium term, and this small table shows you the reason why. This is vehicle ownership per 1,000 people. The latest data is 2013. 2014 is not out yet. You can see that in China, there are only 88 cars per 1,000 people. In the United States, there are 792. Each family has almost 3. Western Europe, 569. Canada's in between Western Europe and the US with about 600. And if you look at India, there are only 26 vehicles per 1,000 people. Mexico, a very young age population, 286. So I think as we build out motor vehicle sales and production, this is very gasoline intensive, it is very metal intensive. And we expect that, as I mentioned, around 2017-18, the bull run is going to move back into force for many of the base metals. But China's potential to grow is slowing. They've got terrible air pollution now, as you know. So a lot of this growth in the auto sales is not going to be in the first-tier cities. It's going to be in second and third-tier cities. I actually missed a train last fall because it took 3 hours to go from the Beijing International Airport to the South Beijing railway station, and causing a lot of consternation for the people waiting for me in Tianjin. So in the meantime, the Federal Reserve Board has been doing all it can to kickstart the US economy. And the chart in the blue shows the federal funds rate, which is at the bottom of the term structure of US interest rates. And you can see that it's been virtually zero for quite a number of years. And I think the recent indications from the Fed point to Mrs. Yellen being very careful about the timing and the magnitude of the kind of increases in the Fed funds rate that she is probably going to put in place at some point later this year. And it's one of the reasons why I think there has continued to be optimism about growth in the American economy. It's one of the things that has buoyed up equity markets in the US just in the past 2 months. We do, however, think that the Fed will move to increase the Fed funds rate probably around September of this year, but do so very carefully, because as the Fed shifts interest rates higher, probably the US dollar, which has really moved up a lot in the past year, is going to move even higher. And there's a little bit of concern about the impact of that on US export competitiveness and employment in some industries, and of course, it could be destabilizing for some emerging market currencies. So I'd just like to show you this chart. It shows US motor vehicle assemblies, very important for base metal demand and steel in the United States. And you can see that the auto assemblies have fully recovered from the Great Recession in 08-09. And in fact, we're expecting production across North America to move up to a new all-time record high this year, and exceeding the previous peak back in the year 2000. Employment, very good performance in the United States in the past year. March was a little weaker though, which causing a little bit of consternation at the Fed. So the US dollar, the blue line on my left-hand side, US dollar trade weighted. You could see the real move up there in the past year, causing some competitive issues in the United States, but with many other currencies, one being the Canadian dollar, and many of the LATAM currencies moving down quite substantially against the US. The weakness in those currencies has been quite a cushion for mining companies in those areas, because although commodity prices generally are on the soft side, the actual valuation of US dollar prices is a lot higher in local currencies. We expect the US dollar to move irregularly higher over the next 12 months, though not to the extent that it has in the previous 12 months. So here's my chart on copper, and of course I love this chart because it shows the incredible profitability of copper prices up until recently, with an all-time peak of $4.60 a pound on February 14, 2011. But copper has slipped this year, I think mostly because of broad-based anticipation of quite a lot of new mine development coming on stream around the world. And we note First Quantum's Sentinel project, and expansion in Zambia, a lot of expansion in the DR Congo, expansion in Peru, and expectations for very strong production in Grasberg in Indonesia for next year. And another big project, Las Bambas, probably coming on stream around 2016. So my copper price forecast is an average of $2.75 a pound for this year. Now, it might come in a little lower, perhaps $2.70 a pound. I think it will be lower than in 2014 at $3.11. And 2016, I'd say again, $2.70 to $2.75. But I think once we get to 2017-18, a lot of the mine expansion that the industry is anticipating is actually going to be over. And at that point, I think copper will jump up, possibly back up to the $3.50 a pound level. You can see coming out the little table in the middle of the text here shows you China's refined copper consumption. And of course, that massive infrastructure spending program that they put in place back in 2009 led to a 25% increase in volume terms for copper consumed in China in that year, a year of general recession in the G7 countries. In 2015-16, we're expecting 4 to 5% growth in refined copper demand in China. Not a bad number, but of course a lot slower than in previous years. Now, I like to point out positive developments for audiences and not always to talk about weakness. So zinc is my pick for the next big base metal play. And in fact, I think we're beginning to see it in the marketplace now. Zinc is trading at $1.01 per pound, and I expect that in the next couple of years, it's going to move up to about $1.50 a pound. The reason for this is mine depletion. Both Century and Lachine in Ireland are going to be closed in the third quarter of this year, and I think investors are already beginning to anticipate tighter supplies, not only of refined zinc, but also of zinc concentrates. And you're beginning to get that anticipation built into the price. Gains in world mine production for zinc from 2013 to 17 at 3.6% per annum are likely to fall short of global demand growth at 4.3, even though there will be some brownfield startups. There's very tight equity capital for junior miners, and recently some of the junior mining projects for zinc actually have moved into bankruptcy proceedings, unfortunately, though I think the particular projects are going to come out looking quite good as we move through the decade. One thing that's very interesting in China is that Chinese domestic auto manufacturers are showing more interest in using galvanized steel and not just crude steel in cars. And I think over time, that's going to lead to a stronger market for zinc. These are just the top 10 zinc producers in the world, led by Glencore, Hindustan Zinc, Teck Resources of Vancouver, MMG Limited, though when Century is closed in the third quarter, they will drop down substantially. Boliden, Nearstar. and a few Canadian companies like Hudbay Minerals, Lundin Mining, likely to do very well in the next few years. So that's just a little advertisement for the bank. For those of you who are not familiar with Scotiabank, we are a multinational bank. We are the top corporate mining bank in Canada and the number 2 in the whole of North and South America. Scotiabank has operations right down through Central and South America with major mining offices in Santiago and in Lima and in Bogota in Colombia. So thank you all very much.
Thank you very much, Pat. Thank you very much, Pat. We're going to move on to our next speaker now, one of the most insightful and successful participants in our industry, Mr. Herb Black from American Iron and Metal. Herb has been chairman and CEO of American Iron and Metal since 1970. They have locations in 70 locations. They're headquartered in Montreal and do over $2 billion annually in sales. So please welcome Herb Black. Thank you.
Good afternoon, everyone. Thank you very much for coming. I have a few words of wisdom to share with you. The first one is there's no future in the past. You justify a short-term loss in the market with a long-term view. It's easy to look back and tell me what happened last year and the year before and the year before that and the year before that. But tell me something. Do you know whether you're waking up tomorrow morning or not? Same questions we have to put forward in terms of the copper market. I've been trading copper since I'm 19 years old. My first successful trade in the copper market, a friend of mine who worked at Miles Metal Corporation, who handled all the copper coming out of Anaconda American Brass from Chuquicamata, called me up on a Thursday and told me, Herbie, copper's going up. And I said, why is it going up? He said, trust me, Herbie, copper's going up. And I trusted him and I bought copper. And believe it or not, on the weekend, they devalued the pound sterling by 14.1%. You could check it, 14.1%. And I bought the copper in pound sterling. And I was so bright, I didn't realize that the exposure I had in the pound sterling, and when the pound sterling went down, the copper market went up. I made $80,000 that weekend. I was a real professional copper trader. Copper never went anywhere, but the currency changed, and I made $80,000 in the copper market. And subsequently, in 1996, supposedly the Chinese were really bullish on copper. I couldn't find one Chinese corporation that wanted to buy copper, and in fact sold copper short. And copper plummeted from $2,700 a ton to $1,700 a ton in 6 weeks. I made a substantial amount of money. But prior to that, the previous year, I dropped a few $1,000,000 testing the short side of copper. In fact, the Chinese were short the market throughout the whole period of 1995. And Hamanaka-san Sumitomo was extremely long the copper, and they had the backings of major corporations, Morgan Stanley, Merrill Lynch, and I could name a few others. They went so far as to lend Hamanaka-san Sumitomo money by creating, and this is all documented, fictitious trades or options to grant money to fund one of the largest squeezes in the copper market in the history of the world. And why am I bringing that up? Because it just proves that when Hamanaka-san owned 2.5 million tons of copper coming due in a 6-week period, it really didn't matter what the economic growth was or wasn't. It didn't matter what you thought about the copper market. It didn't matter about anything other than technically Goldman Sachs, Sumitomo, Merrill Lynch, And all these big players that were in on this play, Goldman Sachs only got into the play subsequently, but not in the initial play of funding Sumitomo to buy all this copper and have it all come together, and the backwardation was running at $25 to $100 a day. It had absolutely nothing to do with copper, nothing to do with consumption, nothing to do with automobiles. In fact, it was just a huge market manipulation. As I recall, $150 million was paid to the CFTC for the COMEX participation of Sumitomo in those squeezes and what was going on in the copper market at the time. So let's fast forward, though, because there's no future in the past, as to what's going on now in the real world. There's very few people that are in the real world, but most of the people here that run scrapyards are in the real world. They got payrolls, they got overhead, they got to meet their commitments. They committed themselves to buy material, they're selling material, and that's the real world, not the paper flying back and forth. I don't know whether people realize today how copper is traded, but there's such a thing as momentum traders. If it starts going up or it starts going down, you get onto that train and you ride the train. And then there's intelligence funds, where they see a bullish word for copper, so that triggers buying for copper, which triggers the momentum buyers for copper, which triggers the general public to believe, oh, copper is a great investment, we should buy copper. And then all of a sudden, at some number, for whatever the reason is, it stalls, and then it starts to go down. If you follow the copper market closely, you'll see that I remember one night I got a call that fell 20 cents in less than 2 hours. Now, what did that have to do with anything other than market manipulation and the way the whole thing was being handled? And recently they had in the Wall Street Journal, where there were, I forget the word, not fake trades, but a guy would put in buying under the market and they'd see this huge buying, so everybody started front running the buying that he was showing, and in fact he pulled that and was selling to these people as the market went up, not necessarily in copper. I think there's a war going on in the world. There's 3 wars, actually, aside from what's going on in Yemen and what's going on in Russia and what's going on in Saudi Arabia. I think you have a currency war. Everybody's doing their best to keep their money as cheap as possible to be able to export their product. The reason for that is because there's excessive production capacity in the world today as we know it, in every field. And to sit here and to tell you that within 1 year or 2 years this is going to be absorbed, I don't believe in magic dates. That's just, you know, we wish and we hope. I'd rather run my business. This is what we know, this is what we have to deal with, and this is what we have to contend with. Because I save my prayers for my health. Everything else I just work at. In case they'll answer those prayers at least, forget about the business prayers we're looking for. And I find that the currency war is really affecting the world in a big way. If you recall, when Europe really started to go into trouble a few years ago, and yet the euro rallied to $1.40, and everyone said, this is ridiculous. Why is the euro at $1.40? You would imagine that if things are getting worse in Europe, that the currency would go down. But then again, common sense is not common. And talk to the analysts and talk to the forecasters, and they'll give you some story, you know, if it doesn't do this, it'll do that. If it doesn't do that, it'll do this, and back and forth. But the reality is that the Europeans, a lot of them, one of the big factors as to why the euro went up in value against the dollar and rallied from $1.20 to $1.40 or more, was the fact that you had people who had to liquidate assets from you that owned them, but they were European based and had European debt, and they had to convert their US dollars and their Canadian dollars and their Chinese currency and the rest of it, wherever their investments were, and they had to repatriate their money and bring it back to Europe. So automatically there was big buyers of euros, even though Europe was going to hell in a basket. And then all of a sudden the euro falls, and now all the banks and all the technicians and all of this and all of that tell you, oh, the euro's got to go to 90 cents, 90 cents. Well, it gets to $1.05, and then it rallies to $1.10, and now God knows where it is. And that's the currency war. And then you have the oil war. And let's review the oil war, and you'll see the impact of the oil on the economy, just like you'll see with the iron ore war. The iron ore and the oil are the two probably largest commodities in the world that are traded. And the iron ore predictions and all the experts and analysts and gurus said we have to increase the production of iron ore because there's going to be a shortage. Well, there's such a great shortage of iron ore, it fell from $165 to $50. Or $55. What's the difference? From 135 to 55. So BHP, Vale, all the major iron ore companies who have as many analysts as we have sitting here listening to me today, working for them and giving them and telling them how they should invest billions of dollars. And obviously, not because I say so, but they were obviously wrong. They started to produce too much iron ore. And so where does iron ore bottom out? And when does it bottom out? And let's go back. So there's an iron ore war, there's a currency war, and there's an oil war. And you ever hear that expression, figures don't lie, but liars know how to figure? So everybody believes and everybody reads in the newspaper, and I'm giving you round numbers that out west, not as west as we are today, I guess east from here, we produce oil in Canada. And the cost of that oil is $70 a barrel. And I'm sure most of the people here who read the newspaper will confirm that more or less it's $70 a barrel. So one would say that, well, at $70 a barrel, the price of oil cannot stay down at 50 very long. That's what most people believe. But in my humble opinion, they're wrong. And the reason why they're wrong is because that $70, the first 62% of the $70, let's call it $42, is the discovery of the oil and the infrastructure of the oil. The $28 is the fact of what it takes after everything is put into place to pump the oil. Now, they have bonds to pay, they have mortgages to pay, they have banks that they owe money, they have syndicates that have invested in this. And some of these banks, some of these syndicates end up taking over the oil company. But let's leave aside who owns it. Anything over $28 a barrel that you pump is positive cash flow at that point. Your initial investment is gone. And you can't wait for $70 a barrel. And it's not even relevant to $70 a barrel. It's, as we all know here as buyers and sellers of scrap, nobody cares what you paid for your scrap. What's important is what you can sell it for. And the Arabs, if you go back to the 70s, and don't hold me to the exact date because I didn't do my homework as well as professionals would, but I will give you my call on that. You probably remember, the older people will remember when we had a big squeeze in oil and the Israeli problem with the Arabs, and all of a sudden oil starts to shoot up. But then peace was made, but the Americans never ever forgot what transpired. And even though there are great battles between the Republicans and the Democrats, they decided that under no circumstances are we ever going to be held hostage again for energy. So no matter who got into power, they always supported. What did they support? They supported windmills. They supported panels, electric panels or solar panels. They supported alternative energy. They supported ethanol. They supported, and you could say, well, ethanol is only 1% or 0.75%. And you could tell me that solar panels are only 1.5% or 2%. And you could tell me that some of these ulterior things are only 5% of the consumption. But I think we all know that 5% excess in the world of anything really drags the price down, just like 5% shortage really pushes the price up. And so the Americans really hit it big, and they start drilling, and they figure out how to drill horizontally and how to drill vertically. And they spend a lot of money in that area, and they become refined in that area. And all of a sudden, let's go back for a minute to the 80s and 90s. Saudi Arabia, the children from the Middle East, that they've making a lot of money pumping oil and getting away with great prices. They send their kids to America. They're educated at Princeton and Yale and Harvard. And those kids, some go home, some don't go home, some adjust to the American way, some of the kids, they remain loyal and faithful to their religion and to their beliefs and their family. But these are intelligent people and well-educated and came from America in actuality. And they go home and they realize that 2 and 2 is 4. It's not 6 and it's not 8. And they realize that they're going to produce oil, and if they keep the umbrella as high as $110, they'll never be able to sell all their oil, because the alternative energies that are coming out, and the oil out of Canada at so-called 70, which is only 28, the oil out of the drillings in America, which, at $50 are closing down the gas rigs, or the drillings. It's amazing how they shut down, 30–40% of drillings, and they pump more oil. Isn't that magic? And it's amazing how human nature is, that when you have to make do with less, you make do with less. And when you have to learn how to cut costs, you cut costs and take shortcuts. And so they're sitting on a panel at home and they're discussing with the powers to be and saying, you know what, if we keep the price up, we will never be able to sell our oil. And they come to the common conclusion, and I think everyone who trades metal here knows, if your price is not competitive, you're not going to sell your product. It's that simple. Common sense is not common, but that's pretty common sense, pretty basic. And so the Arabs don't consider it, or the Saudis don't consider it a war. I consider it a war because they got to knock the other players out of business, and they keep pumping, and everybody keeps pumping. And granted, the projects that are going to take place in 5 years from today and 10 years from today, the research at this point is not being done. So yes, eventually it will catch up with us. And every boom guarantees a bust, and every bust guarantees a boom. But we all have to pay our wages every week or every 2 weeks. And we're trying to invest a little bit of capital in our business. How many shredders have been closed down in America in the last 2 years? And how many new people are trying to conquer the shredding world and opening up shredders, even though we all know there's overcapacity in shredders? So with those wars going on, and now we come back to copper, and I was invited by JP Morgan to a wealth investment group in Florida, high net worth. And a guy sitting beside me, and we exchange cards, excuse me. And this was back in 08 when copper was trading at $4 a pound. And he says to me, what do you think about the copper market? You seem to be in the business. And I said, I am. I said, why do you ask? He said, well, I bought $300 million worth of copper, put it in a warehouse, and I'm saving it for my grandchildren because I think, money doesn't have any value and we're better off owning copper. Now you tell me how many, for lack of choice words, idiots are going to buy $300 million worth of copper and put it away so we can make the chart look good and say that the consumption just keeps going up and up and up. Well, look at the consumption of gold. You know, gold's going to be $2,500, isn't it? When it was $1,900. Everybody said, got to go to $2,000, $2,500. Well, why is it $1,200 now? And why should it have ever gotten to $1,900? So the world is really being taken over by people who have big money, no idea as to where to invest it, pressing all the time to find the next thing that's moving or going or happening. And I don't think any of these forecasts mean anything at the end of the day, because the reality is, I could stand here and tell you with all honesty, you might see 225 for copper this year. Maybe it'll average out at 275 or 270, and maybe it'll go to $3. It just depends how many Paulsons there are out there that are prepared and how many followers there are to follow him and give them their hard-earned money, or money they actually didn't earn, but they got it through the lucky club. And you find people chasing the same assets and pushing it up. And how much copper is really consumed in the world. And with the mega wealth that's out there, one guy today could decide that copper is the best thing in the world to own, and within 3 months he could have copper trading at $3 or $4 a pound. Because there's people with net worths of $25 and $50 billion. All you need is one individual or a small corporation that believes in a commodity, and they say, okay, zinc is a great commodity. And during that period of time, that market is going to get squeezed, and that market's going to go up, and that market is going to take every short out of the market, because the people who genuinely hedged their copper at $3 a pound, thinking it was a great deal because their cost of production was $2.50 or $2.25, get blown out of the water at $4. They don't have the cash to support the position. But it has nothing to do with consumption. And I've been trading, I've been in the business for 55 years. I've been trading since I'm 19 years old. I have never, ever in my entire career been more confused and more concerned than I am in the past few months, for the simple reason that it really has nothing to do with reality. You could throw all these different numbers at me, and you could tell me about the mine production, you could tell me about I don't believe the consumption in China is anywhere, not consumption, I don't believe the growth is anywhere near 7%. 30% of our customers that we deal with have closed up in the last 18 months. There's cities and towns built in China that are not even being used. When you talk about India and you talk about infrastructure, I don't know how you're going to move all these cars through the roads. I've been to India. I don't see where they could, forget about parking them, just driving them. It's just, to me, but you got to remember, I just have a high school education. It just, I don't know where maybe they'll put sky hooks in over there. And they can move the cars around, you know, elevated. They're developing cars like that. So I think that one has to be able to buy and sell and deal with the reality today. And the reality is, in my humble opinion, that it's 2 to 5 years away before this thing turns around. And any turns prior to that are temporary turns, and you're going to get violent fluctuations in the market. And I think it's important not to lose sight that there is excessive production capacity. China today is sitting with 50 million tons of billet on the ground. They were producing between 7 and 10 million tons of excessive steel product last year. They've now reduced it 5 to 7 million tons a month. The hot roll coils are trading level or at a discount to rebar or slightly higher, which is totally ridiculous. But yet China just keeps producing. And yesterday, China decided that they're alleviating the aluminum situation and not charging duty to ship it out of China. Well, what's that going to do to the world market of aluminum? I think it puts it under tremendous pressure. And I just feel that we're in very difficult times, and the free money and if it was that easy, you just print money in America and you buy bonds so the interest rate goes down. Now we have a problem in Europe. We just print money and that goes down. And the stock market flies and the currency goes down and everybody's happy and we're coming out of this recession and we're just going to buy more cars. Well, tell me something. How many people here bought a new car and financed it for 7 or 8 years? How many people realize you can buy a car and finance it for 7, 8 years at a low rate? Is that unbelievable? What do you think a car is worth after 7, 8 years? What kind of equity is going to be in that car? And why is the housing so slow for the last 5 years? You want to know why it's so slow? Because there's enough inventory and the demand isn't there and the kids aren't making enough money to even go out and get married and have a home and buy a home. That's the real truth of what's going on in America. And tell me something, the stock market has gone up dramatically. Who made the money? I can tell you who made the money. The rich people who could afford to. The guy making 10, 12, 14, 16, 18, and even $20 an hour. How much money do you think he made in this last stock market rise? And one has to look at the demographics. In particular, look at the demographics of China. That's really interesting, really interesting. As a kid growing up, when they brought in the one-child policy, I was appalled at that policy. I thought it was a total injustice. I think you should be able to live your life, and if you want to have a family with 3, 4, 5 kids, at least 2 kids, that you should have that God-given right. Well, the Chinese took it away from their people. And in the 90s, I spent a lot of time in China in the latter part of the 90s. And I have to bare my soul and say that I was working on a major deal over there, and I volunteered to give 30% of the profits and build an orphanage in China as a give back if this deal went through. And it was substantial. I had the potential of making $150, $160 million and giving a donation of $50 million. And after I volunteered that, one of the top guys came over to me and in the corner said to me, Herb, he says, listen, if the deal goes through and things work out, he says, we don't need an orphanage for kids. We need an orphanage for senior citizens. He says, you have no idea of how the senior citizens today are suffering here in China. Well, let me tell you something. It's only getting worse now. We're in 2015. And when you have 2 and you make 1, and then you have another 2 and you make 1, you're on a death spiral. And China has been making 1 out of 2 for many, many years. Maybe not all, but most of them. And now, when you talk about 7% growth when you have 2 to make 1, and you tell me 7%, I don't buy into it. So I think the world is filled with problems. I think over time these problems will be solved. I'm basically, believe it or not, a very optimistic individual. I am. I believe in the future. I believe that there will be a bright future one day, but don't count on a magic date 2015 or 2016 or 2017. I hope it happens. I'd love it to happen. I have 70 operations or 68 operations, and I'd love to see all my businesses flourish, and instead of having 2.5 or 3 of my 4 shredders shut down, I'd love to see them all humming. But at the end of the day, we got to deal with reality also. And there's a reason why we are where we are today. And to get out of where we are today. And even though, yes, America's doing very well with Amazon and with the dot-com era and with all these different things, and America is the best from all the other countries in the world, and I mean that sincerely, but there's a lot lacking, and there's a long, tough road ahead. And in my humble opinion, commodity prices will not rally very much, and it will over time. But you know, we got to live long enough to enjoy that. So without further ado, I don't know, I probably spent too much time talking, but I do enjoy sharing my views and ideas, and I turn the mic over to our moderator. Thank you.
Thank you, sir. I really appreciate that perspective. That's wonderful. Thank you. Thank you very much, Mr. Black. It's exactly the sort of enlightened opinion I think we all expected when we came. Our last speaker today is Adam Minner, and Adam is a friend. He's on Twitter. I'll let him explain to you his Twitter feed later. I follow him there. He's based in Asia, and he writes for Bloomberg View. You can find his work in the Wall Street Journal, Atlantic, Business Week, Bloomberg, Time, the Los Angeles Times, et cetera, et cetera. He's going to talk briefly about his time and his view on the ground in Asia day to day. So, Adam?
And I think I'll just do it from here.
Perfect, okay.
Only have a few minutes here, but why don't I just give you just a nuts and bolts perspective on what I'm seeing with copper scrap in China. I think there's two sort of powerful forces in China right now. One, which Mr. Black alluded to, is demographics. He's right. They have an aging population. It's not just due to the one-child policy. In fact, many people don't realize China started to get a drop-off in a number of children even prior to the one-child policy. As societies get wealthier, they have less people, and China's facing that right now. In fact, last year they started a liberalization of the one-child policy, and they're finding people don't want to have that second child because it's so expensive. That has very practical effects on the labor markets in China. I mean, right now you are actually losing participants within the labor market in China to the tune of about 1.5 million to 2 million people a year. Well, that's going to have a very big impact on labor-intensive businesses, especially insofar as they deal with scrap. When you think about it, in a country of 1.3 billion people, whatever it is, you start taking that many people out of the labor pool. Meanwhile, you've got an aging population, it's going to push up wages, and that's exactly what happened. I think everybody in this room knows the scrap sorters, the scrap strippers, the people who are taking your low-grade copper and turning it into something new. Those wages have more than doubled in the last 10 years, and that's not going to change. And so that's a big impact on your scrap processors that you're selling to, and it's one of the reasons why I believe you're seeing businesses just evaporate in China. It's not, for many of these companies, a viable business anymore. This is not unknown to the Chinese government, and they're trying to deal with it. And the other powerful force in China, of course, is policy. And so much of their economy, the United States economy is also dictated by policy to an extent, but China much more so than the United States. So how are they dealing with this labor situation? Well, there's you can't legislate lowering the wages. You'd have riots around the country. So you're seeing, especially in South China, a movement towards automation and upgrading everything. So they don't want to do the low margin commodity manufacturing anymore. They want to push it up. How are they going to push it up? Well, Guangdong province, which is where so many of you have sent your low-grade material over the years, has decided they're going to automate 80% of the factories down there by 2020. They have a multi-billion-dollar program to subsidize robotics in 2,000 of the world's largest factories. Those factories, of course, are in Guangdong. That's going to have a profound effect on what they want from scrap processors, because if they're going to be automating and moving up the value chain, they're not interested in bringing in low-grade scrap and having huge scrap yards anymore where you've got hundreds of people breaking motors. Those days are over. As you had alluded to me before, you don't have, you're starting to do that stuff now, maybe not the motors, but certainly the mixed metals. Motors too, there you go. The low grade, that audience isn't down there anymore, and they don't want it down there anymore. Now, where is it going to go? There's going to be a market for low grade in China. It's always going to be there to an extent, if only to handle their own low-grade materials. But one of the things that's very interesting now in China, and I alluded to this in our earlier copper session this morning, I guess it was, is that you're starting to see some low-grade materials going into Southeast Asia. And I think, to an extent, it's never going to replace what we had, with the low-grade markets in the 2000s and the 1990s, but you're already seeing Chinese material flowing into places like Cambodia and Laos. And I think as you see, and you will see, the Southeast Asian economies moving over the next few years, and it's not going to be next year, it's, we're talking the latter part of the decade, you're going to see markets for that kind of material open up because the labor is so cheap in places like Cambodia and Laos, and they will want it, and there is going to be Chinese money coming in to actually build up that infrastructure. China's different than the US, and different from Canada. In North America here, we hate it when we see businesses leave. They are actively encouraging relocation of low-grade manufacturing, commodity manufacturing into these bordering countries. Southeast Asia, why? It extends their reach, but they also know they need that supply chain. So that's the shift that's happening, and these are very, very profound shifts. Anybody who's been in Guangdong or Zhejiang with another copper processing region in the last 3 months knows it's not what it was, for the last 15 to 20 years. Something has profoundly changed. Just the lack of people that were there is a profound change. And so I think
$20 a week in Cambodia.
Yeah, at $20 a week in Cambodia. Less than $100 a month in places like
Vietnam, Cambodia.
Yeah. And so it's going to be a very profound shift. It's already happening. The demand isn't there yet because Southeast Asia is also, because of the Chinese hangover, it's not moving, but it will. And I think 5 years from now we're going to be talking about a much more diverse market, meaning diversity of countries buying the low-grade material. So I think I'll leave it at that, and I think we have 2 minutes for questions.
Thank you, Adam.
Yeah.
Sorry.
It's okay.
One of the things I was quite certain of when the panel was announced was that we could have held this session well into 5 o'clock this afternoon and kept everybody interested. So thank you very much for your time and your patience for the panel. We do have a couple of minutes, and I would love to open up the audience for questions and kind of keep the ball rolling. Mark?
Thanks, Chris. Question I have for you is, I'm hearing that it is a battle really between supply and demand, or the factors of supply of all the commodities and the factors of demand of all these same commodities. I think that both Herb and, our analyst here have both touched on that. And I would like you, if you would, to kind of expand a little bit on what you think, if you think that's a correct diagnosis, if it is a question of the factors of supply and the factors of demand, and where that's going to end up.
Well, I would agree. There seems to be a lot more than ample supply of so many commodities, and it is more than ample because we continue to boost production, for example, in copper, in a very lackluster market that isn't growing quite the way it was in the last decade. And of course, China is one of the reasons, because economic growth in China is slowing quite markedly, as my two fellow panelists have alluded to. And the global economy is not really performing the way it was again in the second half of the last decade. So you've got very competitive conditions for a lot of commodities. Now, there are going to be a few star performers, and that has to do with much tighter supply developing in the next few years. One is zinc, which I mentioned to you.
I think that the copper numbers in the past have been skewed, as you probably all read in several journals about how the Chinese were buying copper and funding it 2 and 3 times and using it for a financial tool versus using it for electrical purposes or something else. So when you get that demand, and then you have the analysts that are working for major copper corporations, and they're saying, okay, well, there's a shortage of copper and the copper growth is at such and such a rate. Well, is that really growth when you put it in your garage? I don't think so, but there again, but it is demand. And it really doesn't matter who buys it. And then the day they want to sell it, it changes the demand. So I think there's so much money that's being poured into these small markets, and it is relatively small, that it's very difficult to really know when you have too much or too little of a commodity, because the distortion is so great over several months or even a year or two period of time. And so when you say it's a demand-supply situation, well, if you take steel, for example, yes, there's a game played back and forth, but at the end of the day, they don't really have exchanges for steel like they do for copper, aluminum, and nickel, and silver, and gold. But at the same time, you do have weather that plays a major factor with it also. And some people are spoiled, and they, like every dip now, when the stock market goes down, you have to buy it. It's a great opportunity. Well, guess what? One day that opportunity is going to kill you, because it won't bounce back. You'll buy it and it won't bounce back. And so with metals here, there's always a battle to sell, to buy. It's a seller's market, it's a buyer's market. But one has to remember that scrap is the mine above the ground for all the metals. And you can move your copper scrap as long as you discount it to the COMEX or the LME, and there's no shortage. There's no shortage of anything right now. And if you're going to tell me that this is going to pick up and that's going to pick up, it might, but it might not. And the most important thing, I think, for everybody here or the people who are in business is to make sure you have enough marbles to play tomorrow. And you don't want to wake up and find out that you saved your copper at $2.70 a pound because you thought it was going to $3, and now it's $2.20 a pound, and you have serious pressure. That's my only advice to people is forget about holding and saving. You know what? If it starts to go up, you'll buy first and sell after. But if it goes down, you won't get killed in the process.
That's sage advice. Thank you very much. We've gone about 5 minutes over. Are there any other questions from the audience? If there are, well, okay. Seeing there are no questions, I'd like to thank all of you for coming in, for joining us today. I want to thank our exceptional panel for doing such a nice job. And I want to encourage you to enjoy the rest of the weekend in Vancouver. Thank you.